Imagine waking up, um, reaching over to grab your phone off the nightstand.
Right, before you even have your coffee.
Exactly. You squint at the screen and you see that your entire life savings, like money you've bled for, saved for decades, just dropped by 90% while you were asleep.
Just completely gone.
Gone. Now imagine your neighbor waking up, pouring his coffee, checking his phone, and realizing that a joke digital token he bought yesterday, literally a picture of a dog wearing sunglasses, just paid off his entire mortgage.
It sounds like fiction. I mean, it really does.
But that is the cryptocurrency market. It is the ultimate modern financial paradox, and it's happening right now, every single day on the exact same digital exchanges.
It truly is a staggering environment. You were looking at an ecosystem where the highs aren't just good, they're stratospheric, life-altering wealth events.
Yeah.
And the lows aren't just a bad quarter, they are completely ruinous generational wealth wipeouts. We're dealing with an asset class that functions like a fire.
Like it can heat your home or burn it down.
Precisely. It can keep your family warm or burn your house to the ground. And the fire itself doesn't care which one it does. It operates completely devoid of morality or, sympathy.
And that duality, that exact friction between life-changing wealth and total financial destruction, is what we are exploring in this deep dive today.
We have a lot of ground to cover.
We really do. We've got a massive stack of sources to go through, primarily centering around a really heated, incredibly insightful debate that recently took place on the Money Matters show.
And they were really getting into the weeds on this.
Oh, absolutely. The analysts over there were tackling the existential nature of cryptocurrency, trying to pin down what this phenomenon actually is. And our mission for you today is to take the research, unpack the underlying mechanics of their arguments, and, well, really try to settle this debate for you.
Right, because everyone listening has probably asked themselves this at some point.
Exactly. Is crypto what the sources refer to as paisa bana kamauka, which translates to a genuine, historically rare opportunity to build lasting wealth? Or is it simply a highly sophisticated, globally networked digital casino disguised as a financial revolution?
Well, before we delve into the mechanics of those two opposing views, it is absolutely crucial to set the stage regarding our methodology today.
Yeah, that's important.
We are looking at this ecosystem purely through the lens of the provided sources, and we are doing so with complete impartiality.
No taking sides here.
None at all.
Yeah.
We are going to analyze both sides of the coin. We will look intimately at the staggering wealth generation, like a verified stories of retail investors retiring in their 20s.
Or paying off massive, crushing debts overnight.
Right. And we will look just as closely and perhaps more analytically at the horrific financial wipeouts. There's no agenda here. We aren't endorsing the technology, nor are we condemning it.
We're just laying out the facts.
Exactly. We are simply breaking down the mathematical, psychological, and structural realities of how this market operates so that you, the listener, can understand the actual landscape you're stepping into.
Okay, let's unpack this. Because to figure out what cryptocurrency actually is, we first have to observe how it behaves in the wild.
You can't define the nature of a beast without watching how it hunts.
That's a great way to put it. And the most defining characteristic of cryptocurrency, the single factor that absolutely separates it from anything else in the traditional financial world, is its market volatility.
It really is the defining feature.
We really need to establish how its daily price movements completely defy the established norms of global finance. I mean, if you're used to traditional investing, the crypto charts look like a glitch in the matrix.
They don't just defy traditional norms, though. They fundamentally break the psychological models that traditional finance is built upon.
Break it down for us. Let's establish a baseline.
Sure. If you look at traditional, established investing, you're usually looking at indices like the S&P 500. Now, on a truly chaotic day in the traditional stock market, a day where macroeconomic factors are crashing, news anchors are sweating on live television.
The days where financial advisors are fielding terrified phone calls from their clients.
Right, exactly. On a day like that, the S&P 500 might move 1, maybe 2%. If we see a 3% drop, that is a massive headline-making event that triggers automated circuit breakers to halt trading.
Yeah, a 3% drop in traditional equities, and people are instantly debating the onset of a global recession.
Precisely. The traditional system is designed for slow, methodical growth over decades. It's padded with shock absorbers. But then you shift your gaze to Bitcoin.
Which is the flagship asset, right?
Yes. And we use Bitcoin as the example here because it is the most stable, most established and most liquid asset in the entire cryptocurrency space. For Bitcoin, a 10 to 20% price swing in a single 24-hour period is routine.
It's just a Tuesday.
It doesn't even make the news anymore. The sheer scale of the movement is entirely disproportionate to anything traditional investors are trained to handle.
The sources map out a timeline for Bitcoin's historical roller coaster. And when you put the data points back to back rather than looking at them as isolated incidents, the reality is actually staggering.
It really paints a wild picture.
Let's look at the onset of the global pandemic. In March 2020, as global markets realized the severity of the situation, Bitcoin crashed from around $10,000 down to under $4,000.
In just a matter of weeks.
That is a 60% drop. If a major national fiat currency drops 60% in a few weeks, that government would likely be facing a total collapse.
Oh, absolutely. There would be riots.
But with Bitcoin, it didn't collapse. It absorbed the shock, and by April 2021, just over a year later, the price surged to $64,000.
And then the cycle repeated.
Right. As macroeconomic conditions tightened again, the price crashed back down to $20,000 by July 2022. It is this violent, relentless cycle of up, down,
where literally hundreds of billions of dollars in market capitalization evaporate and reappear as if out of thin air.
Exactly. It's mind-blowing.
What's fascinating here is the severe psychological toll that this specific type of extreme volatility takes on the human neurological system.
Because we aren't built for that, are we?
Not at all. We are not biologically evolved to process abstract financial threats and rewards at that speed and magnitude. When a person experiences a 60% drop in their net worth over the course of a single month,
The brain doesn't process that as just numbers on a screen.
no, it processes it as a literal physical survival threat. It triggers the amygdala, the brain's fear center. It floods the central nervous system with cortisol, the stress hormone. You go into a state of fight or flight.
Wow. And then the flip side must be just as extreme.
It is. When that same investor holds on and sees their money multiply by 6 times in a single year, the brain delivers a massive, overwhelming surge of dopamine.
So you're just bouncing between sheer terror and absolute euphoria.
Yes. This constant, unyielding cycle of extreme existential stress, followed by extreme, unearned euphoria, actually rewires an investor's baseline neurology. It fundamentally shifts how they perceive risk, how they perceive value, and how they perceive time.
Which perfectly sets up why the sources dive so deeply into the definition of speculation. Because when the price of an asset is swinging that wildly, driven by fear and greed rather than underlying utility, the argument is that you aren't really investing anymore.
You've crossed the line.
Right.
Yeah.
When you invest in a traditional company, the underlying thesis is that you are allocating capital to an entity because you believe they produce a tangible good or valuable service.
You want a proportional share of the future profits generated by that utility.
Exactly. But in this hyper-volatile crypto environment, pure speculation takes over. Speculation means you are abandoning the analysis of utility entirely.
And you're just placing a bet.
Yeah, you are simply betting that someone else, somewhere in the world, will be willing to pay more for your exact same string of digital code tomorrow than you paid for it today.
That is the core defining difference between the two mindsets. Traditional investing is generally tethered to economic output.
Like if a company manufactures more products or expands its user base, its stock naturally becomes more valuable.
Exactly. The value is anchored to a tangible, auditable reality. In pure speculation, however, the value is untethered from utility. It is anchored almost entirely to collective human psychology, to mass greed, to mass fear.
And to the assumption of what is known in finance as the greater fool theory.
Thanks.
Right.
The greater fool theory. The idea that no matter how overvalued an asset might be, you can still profit as long as you can find a greater fool to buy it from you before the bubble bursts.
Wait, I have to jump in and play devil's advocate here, or at least try to ground this in how retail investors actually experience it. Because crypto purists argue that the exact opposite is true.
How so?
Well, they'll say that because there is no central entity, no corporate board artificially propping up the price with stock buybacks, crypto is the purest form of price discovery on Earth.
I see where you're going with this.
But if traditional investing is like riding a commuter train, it stops, it starts, there's a schedule, and it eventually gets you to your retirement destination, then buying into a token swinging 20% a day feels like strapping yourself to an unguided firework.
That's a very apt analogy.
So, how does the source material reconcile the claim that this is a revolutionary technology with the fact that its price chart looks like a heart monitor during a panic attack? Like, how can anyone realistically focus on the long term adoption of blockchain when their portfolio is screaming at them every single day?
They reconcile it by acknowledging the paradox. The sources point out that the extreme volatility makes it almost psychologically impossible for the average, untrained retail investor to focus on the technology.
Right. You can't focus on the engine design when the car is spinning out of control at 100 miles an hour.
Exactly. And the sources argue that this extreme, unpredictable volatility is the exact fertile ground required to breed the gambler's mindset. It strips away the intellectual veneer of investing in decentralized finance.
And transitions the asset functionally into a digital casino.
Precisely. And that specific transition is where the debate in our sources gets really dark, because the comparisons being made between the cryptocurrency market and a literal casino are not just metaphorical.
They aren't just colorful analogies.
No, the sources argue they are structural. So let's actually take a magnifying glass to the mechanics. Let's look at the math of how the crypto market operates compared to traditional gambling.
Let's use the most classic casino game as our baseline roulette. If you walk into a physical casino and sit down at a roulette table, you are engaging in a system with fixed, transparent odds.
The strict law of probability dictate the outcome of the game.
Right. If you place your chips on red, you know that you have roughly a 47% chance of winning. It's not 50% because the casino has embedded a green zero and often a double zero on the wheel.
The parameters of the game are universally known.
And because they are known, it is an absolute mathematical certainty that the house has an edge over time. In the long run, consistent winning is a statistical impossibility. The casino always wins because the math requires it to.
But this is exactly where the crypto enthusiasts push back. They look at that casino model and say, well, that is exactly what we are escaping.
Because crypto doesn't have a house.
Exactly. There is no casino owner sitting in a surveillance room tweaking the odds. There is no green zero built into the code of Bitcoin to ensure the creator takes a cut of every trade. It's a decentralized ledger.
So how can the sources call it a casino if there is no house advantage?
Because the reality the sources point out is much more complex, and in many ways, much more dangerous. It is true that there is no single centralized house with a mathematically programmed edge.
Right.
But instead, you have a globally distributed market of millions of buyers and sellers, and this market is heavily, heavily influenced and often outright manipulated by entities known as whales.
Whales. For you listening, if you aren't deep into the crypto slang, a whale is an individual, an institution, or a coordinated group that holds such a massive, disproportionate amount of a specific cryptocurrency that their individual trading decisions can literally move the entire market.
They don't just ride the waves, they create them.
Exactly. And because the crypto market, compared to global foreign exchange markets, still has relatively low liquidity, the whales have immense power.
Let's break down the mechanics of how a whale acts as the house. Suppose a whale wants to increase their position in a token, but they want to buy it at a cheaper price.
Okay, so what do?
They can execute a massive sell order, dumping a huge portion of their holdings onto the open market. This sudden, violent flood of supply instantly crashes the price.
Which triggers absolute panic among the smaller retail investors. Like,
Yeah.
the people who only have a few $100s invested see the red candle dropping, their cortisol spikes, and they hit the sell button just to stop the bleeding.
Exactly. It's called stop-loss hunting, or triggering a liquidation cascade. The retail investors panic sell, driving the price down even further.
And then the whale just scoops it all up.
Yes. Once the price is bottomed out, the whale simply steps back in and buys up all the cheap tokens that the terrified retail investors just sold. The whale increases their total holdings at a discount.
And the smaller investors have locked in a devastating permanent loss.
So while there is no official house with a mathematical edge written into the rules of a game, the whales essentially act as the house. They utilize their sheer capital weight and their understanding of market psychology to manipulate the board to their advantage.
They don't need a green zero on a roulette wheel because their capital is the green zero.
That's a perfect way to phrase it.
And if whale manipulation is the equivalent of a rigged roulette wheel, it gets even more predatory when you look at the anatomy of outright scams, or what the crypto world casually refers to as rug pulls.
The sources spend a lot of time analyzing what the industry calls shitcoins.
Yeah, and I know that's a crude term, but it is the technical nomenclature used in the space to describe tokens that are minted with absolutely zero technological innovation, zero underlying utility, and zero real-world use case.
They are designed from their inception purely to separate inexperienced investors from their money.
And the mechanics of how these rug pulls are executed are both fascinating and deeply terrifying. It really is a masterclass in psychological manipulation combined with decentralized technology.
Let's walk through the exact mechanics of a rug pull. First, the creators generate a new token out of thin air using a smart contract.
Because the infrastructure already exists on networks like Ethereum or Solana, creating a new token takes a few lines of code and costs almost nothing.
Right. They keep the vast majority of these newly minted tokens for themselves. But a token has no value if there is no market for it. So the next step is creating the illusion of liquidity and manufacturing hype.
This is where the marketing machine kicks in. They pay influencers, they deploy bot networks on social media to manipulate trending algorithms.
They flood message boards with fake excitement. They make it look like this completely useless token is the next technological breakthrough or the next viral sensation that is going to make everyone rich.
And this is where the trap snaps shut on the retail investor. The retail investor sees the manufactured hype. They see the price starting to tick upward because the creators are wash trading, buying and selling the token back and forth between their own wallets to simulate volume.
So the retail investor buys in with real money, often Ethereum or stablecoins. They put their real value into the liquidity pool in exchange for the useless new tokens.
This influx of real capital inflates the value of the token exponentially on paper. And then the rug gets pulled.
Explain exactly what that means mathematically. Because people hear rug pull and they think someone just ran away with a briefcase of cash.
Right, but it's a structural mechanism in decentralized finance, isn't it?
Yes. It comes down to how decentralized exchanges operate using automated market makers, or AMMs. Think of a liquidity pool as a giant digital vault with two compartments.
Okay, I'm picturing it.
On one side, you have the useless new token. On the other side, you have the valuable asset, like Ethereum, that investors are depositing to buy the new token.
And because the creators of the scam hold the vast majority of the useless token.
They wait until the Ethereum side of the vault is completely full of retail investors' money.
Yeah.
Then, in a single massive transaction, they dump all of their remaining useless tokens into the pool.
And the mathematical formula of the smart contract just spits out all the valuable Ethereum to them. They drain the liquidity pool entirely.
Exactly. They drain all the real underlying value out of the market. And because the pool is now empty of Ethereum, the price of the scam token drops to a literal mathematical zero in a matter of seconds.
So the retail investors are left holding millions of digital tokens that they cannot sell.
Because there is no longer anyone willing to buy them, and there's no Ethereum left in the pool to facilitate a trade, the money isn't just depreciated, it is structurally gone.
Man, if you are sitting there wondering how anyone could be foolish enough to fall for this, the specific example the sources used to illustrate this is just mind-blowing.
The dog token.
Yes. They mentioned a token that was literally just a meme coin featuring a dog with sunglasses. That was the entirety of the project, a picture of a dog with sunglasses.
It offered no blockchain innovation.
It solved no supply chain issues. It had no financial utility. And yet, because of the perfectly engineered manufactured hype, this token pumped 10,000% in a matter of hours.
10,000%.
And the people who bought at the peak, the people who saw that massive vertical green candle on the price chart and couldn't resist the urge to jump in, they lost 90% of their money in under 24 hours when the creators executed the rug pull.
What's fascinating here is the concept of musical chairs. We have to look at the psychology of the buyer in that situation.
Yeah, what are they thinking?
When you buy a coin based on a picture of a dog with sunglasses, you aren't investing. You know you aren't investing. You are willingly participating in a massive, high-stakes, globally networked game of musical chairs.
You are buying in with the full subconscious realization that the underlying asset has zero intrinsic value.
Exactly. But you are betting your hard-earned money that you can ride the momentum of the hype music just long enough to sell your position to someone else before the music stops.
It is the greater fool theory stripped of all pretense. You know you are being a fool for buying a picture of a dog with sunglasses for $500, but you are gambling that there is a greater fool who will log on 10 minutes later and buy it from you for $600.
Precisely. And this highlights a profoundly dangerous illusion of control that plagues the crypto space. Yeah. Think back to the casino analogy.
Okay.
When a rational person goes to Vegas and puts chips on a roulette table, they fundamentally know they're relying on luck. They might have a lucky shirt or favorite number, but deep down, they know the physics of the spinning ball are entirely random.
Right. It's just luck.
But crypto gamblers often trick themselves into believing they are actually investing because they are staring at incredibly complex candlestick charts, drawing trend lines, reading technical momentum indicators.
They convince themselves they possess an analytical system. They dress up their raw speculative gambling in the complex aesthetics of Wall Street.
Which is incredibly dangerous.
Okay, but I have to point out the sheer biological absurdity of this.
Mhm.
Why do smart, highly educated, rational people fall for the dog with sunglasses?
It's a great question.
You can have a master's degree in finance, you can run a successful business, you can be a highly logical engineer, and you can still get your entire portfolio wiped out by a meme coin. It clearly isn't about logic.
No, it's not about the dog. It's not about the sunglasses. It's about the dopamine. It is a fundamental biological hijack of the human reward system.
It absolutely is a biological hijack. It bypasses the prefrontal cortex, the logical part of the brain, and taps directly into the primal reward centers.
And that perfectly transitions us into examining the psychological environment that allows these scams to thrive so effectively.
Because you cannot truly understand the mechanics of the cryptocurrency market without understanding the dark, highly engineered psychology of 24/7 trading. Here's where it gets really interesting.
The physical boundaries of traditional systems versus crypto.
Yes. Think about a traditional casino. No matter how addictive the lights and the sounds are, no matter how much free alcohol they give you to lower your inhibitions, a physical casino still has physical boundaries.
There are massive bouncers at the door.
You have to physically travel there. You have to endure the friction of handing over physical cash to a cashier in exchange for plastic chips. And eventually, no matter what, biology wins.
Get exhausted, you have to stand up, you have to walk out of the
You
building.
have to go home. The physical casino inherently provides an exit. Now compare that to the cryptocurrency market.
The crypto market never closes.
Unlike the New York Stock Exchange, which rings an opening bell at 9:30 a.m. and safely closes at 4 p.m., Monday through Friday, with holidays off to let the market digest information, the crypto market operates 24 hours a day.
7 days a week, 365 days a year, it never sleeps.
There is absolutely no friction. You can trade massive amounts of leverage at 3 in the morning on a Sunday, lying in your bed, staring at a screen inches from your face.
And the sources detail the physical and psychological symptoms of this specific environment, and the clinical overlap with severe gambling addiction is staggering.
We are talking about people exhibiting obsessive-compulsive behaviors, right?
Checking their portfolio apps on their phones 10, 20, 30 times an hour. People setting alarms to wake up in the middle of the night just to check if the Asian markets are pumping or dumping the price.
It leads to chronic, debilitating sleep deprivation, which further degrades a person's ability to make rational, analytical decisions.
And it is all driven by that relentless pursuit of the dopamine hit provided by the green candles when the price goes up, and the panic-induced cortisol spikes of the red candles when the price goes down.
The technology has essentially turned your smartphone into a high-stakes slot machine that you carry in your pocket everywhere you go.
This friction-free, constantly accessible, high-volatility environment is exactly what laid the groundwork for the absolute financial tragedy of the 2021 bull run that the sources extensively discuss.
Oh man, 2021 was wild.
When the macroeconomic environment was flooded with stimulus money and the crypto market was surging to all-time highs, the cultural hype became inescapable.
People weren't just reading about it online. They were hearing stories at family dinners about their cousins making hundreds of thousands of dollars overnight.
They were hearing it from their coworkers. And that relentless psychological pressure cooker, combined with the ease of access, forced completely rational people to make catastrophic, life-altering financial decisions.
The sources outline how ordinary people just completely abandon all fundamental logic. The FOMO, the fear of missing out, was so intense that people were taking out high-interest personal unsecured loans just to buy cryptocurrency.
They were maxing out multiple credit cards to buy digital tokens at the absolute peak of the market.
There were even documented, verified cases in the sources of individuals taking out second mortgages on their family homes, taking the hard-earned equity out of their physical shelter and pouring it into meme coins and volatile altcoins.
They were so blinded by the potential upside, so convinced by the hype that the price would go up forever, that they completely ignored the foundational principles of risk management.
And when the inevitable macroeconomic tightening occurred and the massive 2022 crash hit, when Bitcoin plummeted from $64,000 all the way back down to $20,000, dragging the rest of the market down 80 or 90% with it.
These people weren't just left holding a bad stock in a brokerage account. They were utterly structurally financially devastated. They had massive, high-interest, real-world debt tied to assets that were now functionally worthless.
Man.
If we connect this to the bigger picture, we really have to look deeply at the catalyst for this mass behavioral breakdown. You mentioned FOMO, the fear of missing out.
Yeah, it gets thrown around a lot as a joke.
FOMO is often thrown around as a casual internet buzzword. But in behavioral economics, it is recognized as a profound psychological driver that can literally override logical, rational thought processes.
How does that actually work in the brain?
Well, when an investor sees a token pumping 100% in a single day, the visceral psychological pain of feeling left behind, the panic that everyone else is achieving financial freedom while you are stuck working a 9-to-5 job, forces you to abandon all your predetermined risk management rules.
So you end up buying in at the absolute top of the market cycle, providing liquidity to the sellers simply because the immediate pain of missing out has become mathematically greater in your mind than the rational fear of losing your capital.
Exactly. And what makes this so insidious is that this FOMO isn't just an organic phenomenon happening in a vacuum. It is being actively, aggressively manufactured and weaponized by online influencers.
Oh, the influencers. You have this massive ecosystem of YouTube, TikTok, and Twitter personalities who have built entire media empires strictly on selling the get-rich-quick dream to vulnerable, desperate audiences.
They film themselves stepping out of Lamborghinis, flashing luxury watches, and they look directly into the camera and tell their millions of followers, this new coin is going to the moon. Get in now or stay poor forever.
And this is exactly where we see the symbiotic, deeply toxic, and often legally questionable relationship between the market whales and the social media influencers.
As we discussed earlier, the whales, who hold massive amounts of an illiquid token, have a structural problem. They need what the market calls exit liquidity.
Because if a whale tries to sell $10 million worth of a small token on the open market, there aren't enough buyers to absorb that order.
Right. The sheer size of the sale will crash the price to zero before their order is even half filled. They need a massive, sudden influx of retail buyers to absorb their tokens at a high price so they can secure their profits.
So they use the influencers as their decentralized marketing arm.
Exactly. The whale, or the creator of the token, will approach an influencer. They will either pay them a massive fee in stablecoins, or, more commonly, they will give the influencer a large allocation of the token for free before it launches.
And then the influencer just hypes it up.
The influencer uses their platform to aggressively hype the coin to their millions of followers, manufacturing that intense FOMO. The followers rush to the exchanges, buying up the token, which drives the price up exponentially.
Which creates the exact pool of exit liquidity the whales desperately needed.
Yes. The whales quietly cash out their massive holdings into the real money the retail investors just deposited. The influencer cashes out their pre-allocated tokens, and the retail investors are left holding the bag as the price cascades down to nothing.
It is a perfectly engineered, devastating trap. Let's just summarize the gauntlet a retail investor is walking into here.
It's quite a list.
You have a 24/7, frictionless digital casino sitting in your pocket. You have a biological cortisol and dopamine addiction loop tied to the flashing red and green charts.
And you are up against a highly coordinated, well-funded marketing machine consisting of market-manipulating whales and highly persuasive influencers manufacturing weapons-grade FOMO.
So looking at all of this structural danger, you really have to stop and ask the fundamental question of this deep dive. If the system is this overwhelmingly stacked with scammers, mathematical rug pulls, and psychological traps, how has anyone actually built genuine, lasting wealth in this space?
Because the sources absolutely acknowledge that real wealth has been built.
Right. People have secured their financial future. So how on earth are they doing it if the water is this full of sharks?
This brings us to the pivotal transition in the arguments presented in the sources. We move from analyzing the absolute worst elements of the crypto space, the manufactured hype, the blatant scams, the dopamine-driven gambling, to exploring the legitimate, rigorous investment argument.
How did discipline and education change the game?
Exactly. How do they transform the exact same digital asset class from a rigged roulette wheel into a profound investment opportunity? The sources highlight a fascinating debate featuring David Schwartz, the prominent cryptographer and former chief technology officer of Ripple.
His underlying thesis cuts right through the noise to the absolute heart of the matter.
Yes, his distinction between the two mindsets is crucial, and it's something every listener needs to hear. Schwartz argued that true investing is fundamentally based on rigorous research, on deep technical analysis, and on a foundational understanding of what the asset actually is, mechanically, and why it provides value to the world.
When you invest, you are making a highly educated, calculated decision based on verifiable data and utility.
Gambling, on the other hand, relies purely on the hope of luck, with absolutely no real knowledge of the underlying mechanics of what you are putting your money into.
It sounds like a simple, almost academic distinction,
Right.
but in practice, in a market this volatile, it is profound.
Hmm.
Let's look closely at the profile of a truly successful crypto wealth builder, as thoroughly described in the source material.
The person who actually built sustainable, life-changing wealth in this market wasn't the person who bought a meme coin in 2021 because a billionaire posted a joke about it on Twitter.
No, the truly successful investor profiled in the sources is the person who bought Bitcoin back in 2015.
And we have to remember the context of 2015.
In 2015, buying Bitcoin wasn't trendy. There were no slick apps with friendly user interfaces. It was highly technical, it was difficult to secure your private keys, and the entire asset class was being widely, publicly mocked by the traditional financial establishment.
JP Morgan was calling it a fraud.
Exactly. But they bought it anyway based on their own research, and more importantly, they held it. They didn't panic and sell when the price crashed in the bear market of 2018.
They didn't liquidate their holdings during the terrifying macroeconomic pandemic crash of March 2020.
And they didn't capitulate and sell at a loss during the brutal crypto winter of 2022. They held their position through multiple, devastating 60 to 80% drawdowns.
And the central argument the sources make is that the only way a human being is psychologically capable of holding a volatile asset through an 80% crash without panic selling is if they genuinely deeply understand the underlying technology and why it holds long-term value.
The sources outline exactly what those foundational fundamentals actually are for an asset like Bitcoin, and the two major pillars are absolute scarcity and decentralized mutability.
Let's look at scarcity first.
Scarcity means that there will mathematically only ever be 21 million Bitcoins in existence. It is hard-coded into the protocol, it cannot be altered, it cannot be inflated, and no board of directors can vote to issue more shares to dilute your value.
And decentralization means that there is no central bank, no government administration, and no single human entity that can just decide to turn on the money printer and debase the currency to cover sovereign debts.
Which is exactly what happens with every fiat currency in the world, like the dollar or the euro.
If we connect this to the bigger picture, understanding why that specific technology has value, understanding the profound macroeconomic implications of a hard cap of 21 million units in a world of infinite fiat money printing is the only psychological anchor strong enough to weather the violent storms of crypto volatility.
Because if you don't understand the technology, you are only looking at the price action on the screen.
And if the price drops 60%, your brain assumes it is going to zero, and you panic sell at a massive loss. But if you deeply understand the value of a decentralized, immutable ledger, you recognize that the underlying technological protocol hasn't changed one bit just because the short-term market price dropped due to a hedge fund getting liquidated.
It is the ultimate philosophical difference between price and value. Gamblers care exclusively about the price action on the chart today. True investors care about the underlying technological value of the network over the next decade.
That is the core distinction.
Okay, let's unpack this, though, because I have to jump in here and point out what seems like a massive, glaring flaw in this research saves you narrative.
What's the flaw?
Even with all the research in the world, even if you understand the technology perfectly, you can still lose everything. The sources explicitly bring up the collapse of Terra Luna to prove this point.
Yes, Terra Luna.
For you listening, Terra Luna wasn't a joke coin. It wasn't a dog with sunglasses. It was a massive top 10 cryptocurrency project. It was an algorithmic stablecoin ecosystem. It was incredibly complex, highly technical, and some of the smartest venture capitalists and analysts in the crypto space researched it, audited the code, and deemed it to be an incredibly safe, revolutionary financial instrument.
People put their entire life savings into it because the fundamental research looked brilliant on paper.
And yet, it completely collapsed. The algorithmic peg, The complex mint and burn mathematical mechanism designed to keep the coin valued at exactly $1 broke down under severe market pressure.
It entered what is known as a death spiral.
Yeah, hyperinflating the supply of the sister token to try and save the peg. And in a matter of hours, $40 billion in wealth was completely wiped off the face of the earth. Poof, gone. So rigorous research isn't a magical force field against catastrophic failure.
Hmm.
You can do everything right. You can understand the white paper front to back. You can avoid the hype, and you can still go to zero.
That is an incredibly important pushback, and you are entirely correct to highlight it. And frankly, the sources do not shy away from this brutal reality. The collapse of Terra Luna is the ultimate cautionary tale.
Because even mathematically sound, deeply researched investments can and do fail.
They fail due to unforeseen edge cases in complex algorithmic designs, like the death spiral of Luna. They fail because a new competitor emerges out of nowhere with a drastically superior technological solution. Or they fail simply because global regulatory frameworks change, and a major government abruptly outlaws the project's specific use case overnight.
There's absolutely no such thing as a risk-free investment.
And that truth is magnified 100 times over in a nascent experimental technological frontier like cryptocurrency.
So what does this all mean? If deep research isn't a guarantee of safety and the broader market is littered with whale manipulation and psychological traps, how is anyone, especially a retail investor, supposed to navigate this space without either losing their sanity or going completely broke?
The overarching conclusion drawn by the sources is that research, while necessary, is fundamentally insufficient on its own. Technical research must be paired with an ironclad, unemotional framework of strict financial discipline.
We have established the difference between the gambling mindset and the investing mindset in theory.
Now, if you look at the investors who actually survived the crashes and built long-term wealth, the sources reveal a distinct behavioral pattern. They provide an actionable, practical blueprint for engaging with this volatile asset class safely.
And the beauty of this blueprint is that it isn't just about reading code, it's about managing your own psychology. Let's look at the survival traits of a successful crypto investor. The very first trait the sources identify is a commitment to deep, independent education.
And this goes far beyond just watching a highly edited 5-minute YouTube video from an influencer.
Oh, absolutely. The survivors in this market read the actual highly technical white papers of the projects they invest in. Before they deploy capital, they demand answers to fundamental questions. What specific real-world friction or problem is this technology actually solving?
Who exactly is the development team behind it? Are they transparent? And do they have a verifiable track record of building successful software?
What does their technological roadmap look like for the next 5 years? If an investor cannot clearly articulate the answers to those questions, they have absolutely no business putting their capital at risk.
And that deep education naturally leads into the second, and arguably the most vital behavioral trait, ruthless position sizing. Because the educated investor understands that even great projects like Terra Luna can fail catastrophically. They protect themselves mathematically.
Financial experts and the sources universally agree that highly volatile experimental assets, which encompasses the entirety of the cryptocurrency market, should never constitute more than 1 to 5% of your total overall investment portfolio.
1 to 5%. That means if you have $10,000 to your name to invest, you are allocating a maximum of $500 into crypto, while the rest sits in safer traditional vehicles.
And within that rule of position sizing is the absolute cardinal rule of crypto survival. Never, under any circumstances, invest your rent money.
Never invest capital that you require for basic survival groceries, your mortgage, your children's education fund.
You only deploy capital that you are genuinely, completely emotionally okay with losing forever. In fact, the sources suggest a brilliant, highly effective psychological trick that the successful investors use.
The tuition concept.
Yes. They recommend that when you enter the market, you should mentally write off your initial capital. You should treat any early financial losses not as a bad beat at the casino, but as your tuition.
I love that conceptual framing. Reframing lost capital as tuition fundamentally alters the neurological way an investor processes and reacts to a loss. Think about the casino again. If you lose $500 at a blackjack table, you feel angry, you feel cheated by the dealer, or you feel a desperate, burning urge to win it back immediately.
Which leads directly to what is known as revenge trading, where you take even larger, more irrational risks to recover the lost capital, usually resulting in total ruin.
But if you view that initial $500 loss in the crypto market as your tuition paid to the market gods, you accept it as the necessary cost of a practical education. You take a step back and you coldly analyze why you lost the money.
Did I buy based on Twitter hype instead of reading the white paper? Did I fail to understand the tokenomics and the inflation schedule of the coin?
You extract a valuable, tangible lesson from the financial loss, which mathematically makes you a sharper, more resilient investor moving forward.
And because these survivors are paying tuition and they know the risks, they exhibit the third major trait, diversification. Even within that strict 1 to 5% allocation of their portfolio, they do not put all their chips on one obscure, highly speculative altcoin.
The sources note that while the entire asset class is volatile, Bitcoin and Ethereum are largely considered the foundational bedrock of the space.
And we use the term safest incredibly loosely here, but they are the most established. They possess the largest market capitalizations, the most battle-tested network security, and the highest degree of adoption from major institutional finance.
The survivors ensure that these foundational assets form the vast majority of their crypto allocation, rather than chasing the 100x returns of a dog coin.
And finally, the overarching trait that binds all of this together is stoic patience. The successful investors profiled in the sources think strictly in the long term.
If you're entering this market, you must be psychologically prepared to wait 5, 7, or 10 years for the real-world utility of the asset to actually be reflected in the market price.
You have to train your brain to completely and utterly ignore the daily, chaotic price fluctuations. If you are checking the price of your portfolio on your phone every single day, the sources argue you are not actually investing. You are just agonizing.
The deeply sobering reality that this blueprint reveals, and this is perhaps the hardest truth for new investors to accept, is that true, sustainable wealth creation is incredibly boring.
It is the exact polar opposite of the dopamine-fueled fast cars and luxury watches narrative sold on TikTok.
True investing is reading dry, complex, technical white papers on cryptography. It is the discipline of allocating small, responsible, asymmetrical amounts of capital over long periods.
And it is possessing the sheer psychological endurance to wait a decade to see if your macroeconomic thesis was correct. It requires an immense, almost superhuman level of stoic patience.
It completely strips away all the neon glamour that the social media influencers try to sell. It forcefully transitions cryptocurrency from a magical digital lottery ticket into exactly what it is, just another highly technical, high-risk, high-reward alternative asset class that demands rigorous intellectual and financial discipline to survive.
So we've gone on quite a journey today. We have thoroughly explored the devastating nature of the volatility, the predatory mechanics of the digital casino and whale manipulation, the dark psychology of FOMO and dopamine addiction, and the rigorous, boring blueprint for actual financial discipline.
We really unpack the whole ecosystem.
To tie this all together for you, the listener, I want to break the fourth wall and ask you a direct diagnostic question based on everything we've just unpacked together.
This is the critical moment of self-reflection.
Yes. The next time you are looking at your phone screen and you find yourself hovering your finger over that buy button on an exchange, I want you to ask yourself why you are pressing it.
Are you pressing it because you have read a technical roadmap, analyzed a white paper, understood the tokenomics, and developed a rigorous 10-year thesis on how this specific protocol will capture global market share?
Or are you pressing it simply because you saw a massive green candle flashing on a chart, your heart started beating a little faster, and you felt that familiar primal rush of adrenaline?
That is the ultimate diagnostic question every participant in this market must face. If we synthesize the core underlying lesson from all of the extensive data and debate in these sources, it ultimately comes down to a very empowering yet sobering realization.
Which is?
Cryptocurrency itself is utterly completely neutral. It is neither inherently good nor inherently bad. It is not a financial savior sent to rescue the working class, and it is not a demonic scam designed purely to destroy wealth. It is simply a highly volatile, exceptionally powerful, globally distributed technological tool.
Exactly. It's like a hammer. A hammer can be used by a skilled carpenter to build a beautiful home for their family, or it can be swung recklessly to shatter a window. The hammer doesn't have an agenda.
A hammer doesn't care.
Precisely. Your personal methodology dictates the outcome. If you wield this tool with deep technical research, stoic patience, and strict mathematical position sizing, it can indeed act as pesa bana kamoka, a genuine, historically significant opportunity to participate in the foundational growth of an entirely new, decentralized asset class.
But if you apply hype excessive leverage and emotional FOMO to this exact same tool, it instantly transforms into a predatory digital slot machine that will eventually and inevitably drain your bank accounts dry.
It is a profound responsibility because the outcome is placed completely in the hands of the user.
And this raises an important question, something I want to leave you pondering, that goes slightly beyond the immediate short-term debate presented in the sources. We have focused so intensely today on the extreme chaotic volatility being the defining characteristic of the crypto market right now.
Right.
But as this underlying technology inevitably mainstreams over the next decade, as major Wall Street institutions build infrastructure, as complex regulatory frameworks are solidified globally by governments, and as trillions of dollars of slow-moving institutional capital flow into the space to stabilize the liquidity pools, will that extreme volatility eventually flatline?
Wow, that's a wild thought.
Will Bitcoin, 20 years from now, look exactly like the S&P 500 we talked about at the beginning, moving a safe, boring, predictable 1 to 2% a day? And if it does lose that wild volatility, will the gamblers and the speculators simply get bored and move on to whatever the next wild, unregulated technological frontier is, leaving only the true believers holding the new, stable standard of global wealth?
That is a fascinating thought to chew on as we watch this market mature in real time. Will the digital casino eventually just turn into a boring global bank? We want to thank you so much for taking the time to join us on this deep dive. If you found this breakdown of the mechanics and psychology helpful, please share this knowledge with anyone you know who is looking to get into the crypto space, especially if they are about to hit that buy button based on a meme. Invest wisely, manage your risk, stay curious about the technology, and we'll see you on the next one.